5, 4, 3, 2, 1. Okay, so we're back again with Brian Hogben from Mission 35 Mortgages. Second episode here. If you watched the first one, there was a lot of good information there, but we still had some other questions for Brian. So he was gracious enough to stick around, and we're going to do a second episode here just to kind of address some of the other topics that, we discussed off camera. Welcome back, Brian.
Thanks, Henry. You know what? I think from all the discussions we've had off camera too, we could probably turn this into 10 episodes. There's a lot to talk about in this industry.
Absolutely. So where we kind of left off in the first episode, we were talking about CMHC, a lot of things around information for first-time home buyers, right? A big thing in the news right now is interest rates, right? So during the pandemic, the government's taken some measures to really ease the interest rates to make things a little easier on people. How is that reduction sort of affecting your business? Where do you see it going before the end of the year? And what are your predictions for 2021? Like, what are you advising your clients going forward?
Yeah, that's a great question. And I have never seen interest rates this low. They are legit historically low interest rates right now. So, and the government's done a great job of making it low, and it drives down borrowing costs, obviously. So it makes it cheaper for people to be able to live in their homes, buy homes, stay in homes. As for the balance of the year, 2020, I don't see any movement in interest rates on the upward side at all. I would be shocked, absolutely shocked, if we saw rates go up. In fact, there may even be another small drop, if you can believe it. It's almost going to be like banks are going to be paying you to take their money soon. Wouldn't that be nice? But because we're looking at some of these rates are just they're under 2%. You can lock in for 5 years for rates that are under 2%, in some cases subject to qualification. So seeing that is unbelievable. Now blowing that out to 2021, again, the longer we go, I'll admit my forecasts get worse. Okay, the less likelihood of them being right, but I'll throw it out there. And from a lot of the readings that I've seen, and this pandemic has some longevity to it, as we've seen. If we were talking in April, May, we're like, yeah, by the summertime we'll be fine, right? Behaviors have changed. Businesses have changed. We have yet to see what some of these effects will be, right? Whether there will be a lot of negative ones or not, we've yet to see. Where mortgage deferrals haven't had a lagging effect yet. So all that is to say, again, I'd be shocked to see interest rates go up in 2021, right? So to be in a very, very, very low interest rate environment for the next 1 to even 3 years, to me, seems very reasonable. And something to, keep in mind is that even if rates go up by 1% and you're sitting with a bank, you're okay. There's not an affordability issue there if you're seeing that rates go up by 1%, and that leads to the stress test and how banks are qualifying to get mortgages done. So
we'll circle back to stress tests in a bit.
Yeah, I know that's another one.
With interest rates that low, that's sort of like historic, right? So we haven't really witnessed anything like that before. So has that kind of changed the behavior of, bank lenders, independent lenders? What's the ripple down effect on that?
Yeah, I think, they're lending out money, right? So that's the good news. All the lenders are competitive right now, which is good. So it's, I think the ultimate, beneficiary here is the consumer at the end of the day, because now it's almost a race to the bottom. So even when you talk about banks lowering their rates, even people that would say niche lenders that are like a trust company and credit union, where we talked before about, if you had a little bit of credit issue, or if your income was a little bit more difficult to qualify, even those rates are getting super competitive. Like we're seeing, they would be called a subprime mortgage in the past, or an alternative rate. We're even seeing those at the 3% range. And that is phenomenal. That is phenomenal. So really the ripple down is everybody kind of gets to benefit from that. The irony of it, I see, is that people lose sight as to what they're doing, because we'll still get emails saying, well, you know, I'm seeing 1.89 out there, and then I'm also seeing 1.85, right?
Yeah.
And I think it really comes down to a 0.04% difference might equate to a $5 or $6 a month difference. Like, it's good to put dollars and cents in there,
Yeah.
not lose sight, because it's about the right solution. You don't want to be with the wrong mortgage company that's got a huge mortgage penalty. Do you know what I mean? With a lower
Absolutely.
rate versus one that's actually got a reasonable penalty. So something just to keep in mind for anybody that's watching.
It's interesting that you say that. You know, when you're selecting a mortgage, it's very easy to focus on, you know, what that percentage is, right? But I found out, you know, through the business that not all mortgages are created equal.
Yeah.
And not always based on rate, but on some of the details. My next question to you is sort of, you know, as a transition there, to sort of use the last topic to kind of move forward. I wanted to ask you about how do people get a mortgage to purchase a second property as an investment? But that also bleeds back into the first question, because you know, selecting the right mortgage for that first property might have an adverse effect on purchasing the second property. Could you go into a little bit of detail
Yeah.
on
Thanks.
how that works?
That's a great, and that's really my jam, my passion. I love that. You know, we joke and say the only thing better than one mortgage is two, right?
Exactly.
And the reality is, though, is because that's how you're building your wealth, by buying that second property, right? So getting that second property and really having it. And just to give a quick example of that, because a lot of people think there's a lot of risk in that, but if you have two assets growing simultaneously, imagine having your $500,000 house that goes up by 3%, right? You just
Yeah.
made 15,000. Imagine having two $500,000 homes. That's $1 million that went up by 3%. How much is that? Well, now that's 30,000. And imagine those two mortgages got paid down by $10,000 a year. Well, now your wealth difference, your wealth accumulation by having two homes is almost $50,000 a year instead of just 25, as if you had one. So that's the reason why. But the how, it's simple. Most people who own homes right now, if you've been in the housing market for 12, 24 months, 3 years, you've got a significant amount of equity. You've paid it down and the value's gone up, right? So what you can do is, getting the right mortgage out of that, you can re-borrow money out of your house to purchase another house. So now what you're going to do, like an investment property, like a flip or a rental, there's ways that we can show you that how you can take that money out, because any money you take out of your house, we call it good debt. And good debt means that it's tax deductible. So that money now is good debt on your house, and now you've put it towards an investment property. So one of the easiest ways that we do that is take out some of your existing equity. Basically what that means is, equity is anything between the difference of what you owe and what it's worth. So if your house is worth, I always use $500,000 and your mortgage is 300, you could bring your mortgage up to 400. And now use that $100,000, that extra 100, and use that for the down payment on another $500,000 house.
Excellent. Excellent. So, but are there mortgages out there where they don't allow you to really do that? And that might be where, you know, if this is your plan, this is something that you would want to speak to a mortgage broker about, to kind of, you know, make that known so that you could advise people correctly as to, you know, getting into the right product.
Yeah, thanks for bringing that up, Henry. God, it's almost like this. You got good questions. This is perfect.
Thank you.
So, and it's great because we see this all the time, and this comes back to the rate thing, because sometimes people are so focused on the rate, right? And we say, like, there's two rates, or there's two costs, two rates to every mortgage: the rate you get going in and the rate you get coming out. Because a lot of mortgages that have super low rates, they have what we call a punch in the face penalty. Because, like, when you see what that penalty is, if you break it early, you're going to want to punch someone in the face, because it is so big, right? And a lot of people don't disclose it. So they end up saying, oh, you want the 1 point, the 99-cent special? Sure. But if you try to break it, you're getting that punch in the face penalty at the end. So for people that we're talking to, like your viewers in that, if someone has that $100,000 worth of equity that they want to access and they went with the wrong mortgage company, like if that was their goal, they might still be able to access it, but it's going to cost them $20,000 or $30,000 in a penalty to access it. Whereas if you went in with that plan ahead of time, you could work with a lender that will, have a reasonable penalty. There's different types of penalties, which is a whole nother show. Okay. But there's different types of penalties, or you can go with certain banks or certain lenders will allow you to take out a line of credit. So maybe I keep my mortgage the same in that $300,000 example, and they give me a $100,000 line of credit. And now I can use that big, huge line of credit to invest with. So it's really, really, again, with the right realtor, the right mortgage agent, taking the time to develop the strategy at the beginning helps save so much more money in the end.
Kind of makes a world of difference.
Yeah.
Cashback mortgages. I know in the last episode we talked about zero down mortgages. What are some reasons that someone might want to use or utilize a cashback mortgage? And is that something that you see people sort of taking advantage of?
Yeah, that's a great question. Back in the day, they used to be a lot more popular, right? Now, I think, certain banks will offer cash. Now, there's a difference in the marketplace too. There's cash incentives and cash backs, right? And I think it's a good question for you to ask, because a cash back mortgage will have a premium built into the rate. Okay. So you are actually paying for that cash back. A cash incentive is where it's just, a bank might offer, move your mortgage to TD and we'll pay you $1,000. That's an incentive, not a cash back. And there's no rate premium in the incentive. The cash back ones, you're paying for it. And I typically have been an advocate to say, hey, take the interest rate discount because it will save you more money than if you take the cash back. So if you're typically weighing a cashback mortgage versus a lower rate, the lower rate is better. The reason why cashbacks are offered is, to your point there, to fulfill a need. So the reason for taking a cashback is I'm really short. Like I put all my money together to get into the house and I still need my big screen TV or I still need my
necessities.
Yes, it's very important, right?
Yeah.
Or I still need to paint, or I gotta get rid of the pink tub or shag car. Like I gotta. So in those cases, totally cool. I think it's a great option, right? Because you're getting into the housing market, you're paying a small rate premium for some money. Totally good. But if you're thinking about it just to have it in your account because it feels good, you're financially better off having the lower payment.
Absolutely. Absolutely. Sort of transitioning and moving forward here. Stress tests. Scary to a lot of people, right?
Yeah.
I have a lot of clients. Usually I speak to them. I've had a lot of clients in the past. We talk about stress test, what is it? What are the requirements? It's a terrifying thing. And I know that they've lost sleep over it, especially if, this is their first time purchasing a home, right?
Yeah.
It's really the scary thing that nobody really wants to sort of address. But also at the same time, it seems very difficult to sort of get accurate information on what it even is. How does it work? Especially online. And I got advice from Uncle Jim, that sometimes, more often than not, ends up being bad information. It causes people to not take action. It causes them to have, unnecessary fear. Where I know a couple years ago, when I, was working with clients, stress test was top of mind. The government had instituted some changes. Where do we sit right now from your perspective on where those changes are? Do you see them changing in the near future, COVID related or not? What are you kind of preparing for in the mortgage realm?
That's great. And and it's a great topic too, because it's really been in the news for years now, because they implemented it with one segment. They called it high ratio mortgages, or when you're putting down less than 5 or 10%, or when they were putting down less than 20%, sorry. Then they implemented it for conventional mortgages when you're putting down 20%. So now it's implemented everywhere, all across the board, right? So, and what it is, and people shouldn't be scared about it in the sense, because I think to really look at it, it's a benefit, because the way that I look at it is this. Right now, the stress test rate is 4.79%. So if you're going to a bank and you're going to pay 2%, or 1.9 or 2.5, whatever the rate you're going to pay is, the bank's qualifying you to make sure that you can make the payments at 4.79. So as a consumer or a buyer, if you're approved, they're approving you as if rates are a minimum of 2% higher.
Yeah.
So from a consumer standpoint, okay, cool. If you approve me, and like we talked about on another part there was on interest rate. Interest rates are not going to be moving up by 2 or 3 points anytime soon. I'd be shocked. We will legitimately be in a zombie apocalypse if rates go up by like 3% anytime soon. Okay. I'll be worried about other things. Okay. So I would end up saying that on the stress test. So don't let it fear you. Don't let it be anything other than you're qualified. It's a buffer zone. The banks want to make sure that you can qualify at this rate in order to get into housing. Now, do I think it's excessive? I think it's a little bit high right now. And one thing that was scheduled to change to sort of swing the pendulum back to a little bit more liberal lending, it was scheduled to come out April 1st. There was a scheduled change April 1st for the stress test to make it a little bit easier, because it kind of went really, really hard on the stress test and made it more difficult for people because they made it a tougher criteria. And then they were going to start to make it easier as of April 1st. And we all know what happened the end of March. Other things became important other than the stress test.
Yeah.
So the government took that off the table. Now, what do I think is going to happen in the future with the stress test? Well, I think we're going to see, my optimism and hope is that we're going to see a little bit more lightening on the stress test. And I think, but I don't think it's going to happen anytime soon. And the reason being is because the government's being very cautious on lending. They're very cautious on, monetary policies right now. There's a lot of subsidies going into the market. So for them to start playing with mortgage guidelines anytime soon, I don't think it's in their itinerary. I don't see it in this year, and I don't see a change. And again, I could be wrong. I don't see a change in 2021 on it either. But that could be good in the sense I don't see them making it tougher again, but I don't see that easier change coming either. I see it likely being status quo for the next at least 12 to 18 months.
Excellent. Right now, a lot of things have changed, obviously. A lot of people are out of work. A lot of people have lost their job. This is kind of really a bad time in history for money related, anything, right? What I'm seeing in the news is a lot of people predict that people are going to be declaring bankruptcy. A lot of people are going to be, seeking consumer proposals. Is that sort of the nail in the coffin as far as getting a mortgage in the future? I know the traditional standard was, as you learned from your parents, you'll never get a mortgage, you'll never do this if you do that. Is that true? What's the stigma around that? And if it is possible, sort of how does somebody get a mortgage after a proposal or bankruptcy? And if that's possible, and you outline how they can do it, what sort of steps could they take during the process to make it a little easier on the back end? If that kind of is the goal, right? Because a lot of people are doing this not necessarily out of poor money management, just out of necessity. If you own a store that sells or a restaurant even, or a bar or whatever, you're not doing poorly because you don't you don't want to, or because of poor management or whatever, it's sort of out of your control. So going for, I kind of toss the ball back to you. Sort of
Yeah.
what's that kind of look like on your end?
Well, and I think and I'm glad you brought it up, because we see lots of people, and lots of people, it can be embarrassing for people. It can be vulnerable, right? And I think especially when you got Uncle Jim or mom and dad saying, you can never claim bankruptcy, you can never do a proposal. Reality is it happens, right? And it's important that people know that it's not the end of the world. It really isn't. What I actually see as being the end of the world is when I see someone trying to take every last penny and just make their minimum payments, knowing that it's just not going to happen, right?
Yeah.
And that's where a bankruptcy or proposal really is the answer, because number one, in bankruptcy, typically you're in bankruptcy for a little less than 12 months, right? Once your bankruptcy is called discharge, right? We call it like bankruptcy jail, where a trustee is looking at your financial information with a magnifying glass for about a year, if it's your first one, give or take. Once you're out of that, you get what's called discharge. Now, the bankruptcy stays on your credit report for 7 years, okay? However, once you are discharged, you want to start rebuilding your credit, okay? Now, we have lenders that from the day you are discharged will lend you money. However, their requirements are you must have a down payment. So if you're looking to go bankrupt and you want to buy a house, after immediately following discharge, you would need 20% as a down payment, okay? So it's obviously sounds kind of counterintuitive. You go from having nothing to 20% at the end. But what I will say is, if you have mom, dad, sister, brother, co-investor, friends that are going to work together, that is an option, okay? Or what we do see sometimes is people are able to keep their homes in a bankruptcy. You don't always lose your house in a bankruptcy. So I think it's really important, and this would be another phone call, but really important to have a trusted source to talk to, because filing for bankruptcy is different from a proposal. And we have some great partners and referrals on another, if anybody's looking, we can help out with that. But when it comes down to proposal, which is very interesting, proposal is much more common when we see than a bankruptcy. That means that you're paying out a portion of your debts and you're not wiping out all the debts. You might try and pay back 10 cents on the dollar, 50 cents on the dollar, something that's pre-negotiated. We have a lot of companies that will actually, and one of our specialties is we'll actually help people who have a mortgage, when they file a proposal, help them pay out the proposal with money from their mortgage. Okay.
Wow.
And the reason why it's not the end of the road, and just looking at it from a lender's perspective, a lot of time, when Uncle Jim, sorry, we're picking on Uncle Jim today. I hope he's not for real. Sorry, Uncle Jim. But when we end up paying, when you file a consumer proposal or a bankruptcy, banks, they don't like it. Okay. They might have a minimum of a 2-year requirement to get back into a bank, but other lenders see it differently. They do like it, because you know what they say? They say, you know what? Brian filed a proposal or bankruptcy. You know what I know? He's not getting any new credit for a long time. So I know he's not going to go and rack up more debt because he just filed one. So on another end of the spectrum, that from a lender's perspective is managing their risk then, right? So
that's an interesting perspective. It kind of really is. I never really thought of it or had it sort of laid out that way. So let's say I'm somebody, for whatever reason, I'm looking at doing a proposal. What are sort of the steps that I should be considering if my goal is to have a house in 2 years after the proposal's been settled up or discharged, as you said?
Gotcha. So that's an excellent question. So what you want to do is immediately, once the proposal's paid or the bankruptcy is discharged, get a credit card. Sounds funny, right? But it's like, get a credit card, because lenders want to see, history is history, but what have you done lately? So we typically recommend a Canadian Tire card, like one of those Home Depot cards, something that is like, it's going to be a high interest card. Okay. However, if you pay off the card within 30 days, you're not paying any interest, right? So for those of you that don't know that even if you have a high interest rate card, you can build up your credit rating very good but you don't have to pay 20 or 25% interest. Just don't keep a balance on it, right? So the first thing you want to do is get 2 trade lines. A trade line is a credit card, a car loan, something that shows up on the credit report. That is the best thing you can do. And if you have trouble getting one through another lender, you can end up getting a secured card. So we end up having companies like Home Trust, for example. You give them $1,000, they'll give you $1,000 credit card. So if you've had a lot of issues, trouble getting credit, that's a great way to get it reestablished too. That's the number one thing that lenders are going to want to see post a discharge or proposal.
Okay. Something that I ran into as an agent, which I always thought was kind of funny. I wanted to kind of share with you and get your take on it. I'd sit down with people who were looking to buy their first home, and we'd be talking very sort of high level about what their savings were and their general debt and things like that, which are all questions an agent should be asking you, before you even go out to see a house, right? If they're kind of doing their job at a very high level. One thing that people always asked, answered when I said, do you have any assets? It was, yes, I have this great car. I have this amazing boat. I have, this $10,000 pool table. For young people, right? I know it's very attractive and sexy to pump all your money into, like a sports car as your first investment. How much, in your opinion, and I know your story, and I know, how successful you've been able to, or how successful you've been being able to kind of position yourself to kind of build assets and stuff. How much do you think young people set themselves back pumping all their money into an item like that, which is really not an asset at all, versus saving that for a house? Like, how many years, in your personal opinion, does that kind of put you behind everybody who goes house first?
Wow. That is, oh man, Henry, good one. That is touching my heart, because it's by far the number one thing that it'll set you back a lifetime. I've seen so many clients, because I've done mortgages for years, and I've seen the kids, in their early 20s say, you know what? It's going to take me a little bit longer to save or do this plan for a year. I'm buying a car. And as soon as you buy a car, number one, you got a loan payment because you're not buying it cash, right? And you just bought a depreciating asset, right? And it makes you feel good for a minute or two, okay, when you're driving by and you're smiling at the ladies or guys or whatever you're doing, right? But I'll just use my own story in that, because it's just so, I drove a piece of shit 86 Cavalier. Anybody who has a Cavalier, okay? So I drove
emails from the Cavalier.
Yeah, I know, another angry email. Sorry, but it was terrible. I'm sorry. The door panels were falling off. The exhaust sucks. It was Smurf blue. Like,
so it was just your Cavalier, not Cavaliers in general.
Yes, yes, yeah, thank you.
Exactly.
Yes. My Cavalier, not Chevy. I'm sorry. Okay, so, and I remember I used to leave Auto Traders on my dad's kitchen table. Right? I used to leave Auto Traders on there with cars circled and being like, ooh, this would be a good one to get. This would be a good one to get, right? Yeah. Because I wanted a nice car so bad. And my dad, he looked at me and said, Brian, no one gives a shit what you drive but you. and it's something that always stuck with me, right? But the reason why I say that when it comes down to financing is because I never drove a nice car, and I'm a car guy, right? I was able to buy my first house because I didn't have a car payment, even though it was a $0 down mortgage back then, right? But a car payment, if you have a $200, $300, $400 car payment a month or lease payment, that is a couple $100,000 you're taking away from mortgage approvability, right? And that could be the difference from getting into a marketplace where the average house point is 500,000, right? But you're only approved for 300,000 because you got a car loan. Right?
Big difference.
And I've seen clients that got the car, number one, now you got not only a depreciating asset, but you got an expense now. Now you got to fix it. Now you got to put money into it. That's money that you can't save up and get in. I've seen clients who who I had pre-approved bought a car who have not ever purchased a house in 10 years now. Because the way that real estate is appreciated, they could never, ever catch up. And that might be extreme or dramatic, but I'm telling you, I drive the car of my dreams right now, and I attribute that to sacrificing and buying real estate. And it took me a long time. For 10 years, I'm not saying everybody wants to do that, but the feeling of being able to, be mortgage free or do that kind of stuff is worth way more than the feeling you'll ever get from driving a nice car, because that car is fleeting. Whereas the investment in real estate, so long as you don't do something stupid, will last for a lifetime.
Absolutely. Absolutely. Do you guys work with a lot of investors?
Yeah.
Yeah. How is that relationship kind of right now? Like, are a lot of people investing in investment property? Like, has that slowed down at all?
Yeah, it's a great question. And I would say no. It's if anything, it's picked up because we're seeing appreciation. And I think real estate investment, it's not about timing the market as far as I'm concerned. And someone else much smarter than me said this, it's about the time in the market. I'm not about, like, when you own real estate, own it for a long time, right? I've got almost 30 doors right now between different real estate investments. And I'm not a financial wizard. I just bought stuff and held on to it, right? And I think for real estate investors right now, the really good ones, listen, this is a moment in time for real estate investment where, is it high or is it low? I don't know. The future will tell us. It's impossible to connect the dots in the future, easy in the past. So for people to invest right now, as cheesy and cliche as it sounds, I think it's always a good time to buy, so long as you have a long-term vision, right? To flip a house right now, I don't know, right? I don't know if that would be good or bad. I legitimately don't know, because I think we're in a volatile market right now. But to buy a house and hold on to it for 10 years as a rental or as an investment, absolutely a great idea. And I think other real estate investors that we work with, our real sweet spot is getting people from 1 to 5 homes, getting you, 2, 3, 4 homes, investing in that market, something that has cash flow and pays for itself. So what that means is that so long as the rental income is greater than your expenses, that means you have cash flow, you have money left at the end of the day. It doesn't matter if the market goes up or down, because you don't have to sell it. If you buy something that doesn't make money,
then you got a problem. All right. Well, Brian, thank you again for coming back and being on the show and answering some more of my questions here. I really appreciate it. If somebody is looking to purchase an investment property, or a young person, or anybody really looking to buy a home, how can they reach you? What's the best way to get in contact with you?
You know what? Call our office. Office is great. 905-574-5255. We've got a phenomenal team here that I work with. You can email me directly, mortgages@brianhogben.com. And also too, I just want to throw this out again too. Anybody who's thinking about investing, I wrote these 2 books because I'm passionate about real estate investment. I'm happy to, if you email me with your name and address, I will send them out to you. All I ask for is a review on it, a good one. Okay. But I will give these to you, postage paid and everything like that. And it's all about buying your first investment property. This one's how to get mortgage free. And this one's the story of everything that I did wrong, Mission 35 and real estate investment. So, and I'm just really happy to share it with you guys. So that's how you get it.
Awesome, Brian. Thank you for coming on the show. I really appreciate it.
Thanks for having me, Henry. It's awesome.